Join us now, Thomas Hoenig, former Kansas City Fed president, now Mercatus Center, distinguished senior fellow. It's good to see you.
Thank you.
Thomas, I think it's been a while, and so much has happened in terms of our perception of the economy, rate cuts, recessions, everything else. What do you think is, at this point in time, where are we, and how has your view changed at all about what we need to do if you were on the Fed?
Well, things have certainly changed, and mostly by surprisingly good outcomes. So I think that is a very positive. I think the Fed realizes, and most people do, that the economy is stronger than they thought it would be, certainly stronger than I thought it would be. And going into this year, it remains that way. The one thing they still have is inflation above their 2% target, and they will focus on that, I suspect. And I think Powell, in his testimony, will be very careful to say, we're very pleased with the economy going forward, but we have not gotten to our 2% target yet. And so long as the economy remains reasonably strong, we will continue to shoot for that 2% target. And therefore, he'll say indirectly, if not directly, don't expect rate cuts in the immediate future.
Not in the first half of the year. Your money is still on some rate cuts in the second half of the year?
Well, I think that's reasonable. Whether it's 3 cuts, I don't know, because the economy is really strong. And the other part of it, I think people maybe need to take a look at, is when you think about the economy right now, with the amount of debt that's being issued, with the strength of the economy, there are a lot of economists who are talking about the equilibrium rate for interest, the real rate of being around 2%. And if that's true, and I think it's reasonable, and you have a 2% inflation target, your longer run Fed funds goal should be around 4%, and you're only a point and a half above that when you still have inflation as high as it is. So they may take more time if the numbers stay in the 3% range, as they have been for over a half a year at the CPI level. So I'm not convinced that they'll cut rates in June, but they may, and there will be an enormous amount of pressure on them to cut rates. There's no question about that, and we'll see how they handle that.
Have you been able to figure out why the economy is confounded so many people on being stronger, even the consumer? Is it leftover pandemic stimulus or other fiscal stimulus from the first couple of years of the Biden administration?
I think so, yes. I think most people, underestimated just how much, number one, liquidity was being brought into the economy during that period, and how much fiscal stimulus was being brought in. When you think about it, not just the pandemic issues, but the CHIPS Act and the Infrastructure Act and what I call the Green Energy Act have all added significant spending to the economy, which is boosting it. And while the private sector's investment may be slowing, the public, the subsidies and so forth are there stimulating the economy. And I think that is why the economy has remained as strong as it has. Plus, yes, the consumer has had a lot of excess savings that they've been bringing down, but because the economy has been stronger, the real wages have outstripped inflation for a while. And so their spending abilities are really quite strong even now. Recognizing that January we saw some slowdown in consumers, but I think the duration of their ability to spend is still in play, and that's going to affect the economy going forward.
Well, that's a dangerous lesson if people take it as a new economic model where there's no day of reckoning, and it's basically free lunch, because why didn't we spend twice as much and then we'd have 6% GDP, Thomas? Right. Because in the back of our minds, we know there's $34 trillion out there that's going to require debt service. So when does that happen?
Well, I think that's a real legitimate concern. In fact, I saw yesterday an article being written by economists saying, money's free. Money's free. Let's do that. It's worked so well. And I've also seen more or heard more of people saying, well, 3% inflation is just fine. Let's settle for that. So you do have that coming forward. And the enormous amount of debt that is coming at us and the interest on that debt will eventually, I think, cause us to become a less settled economy as we go forward, because we're siphoning more and more off in the private sector. We have to, either through inflation as we go forward or as government spending continues. And I think the outcome of that is lower productivity rather than the higher productivity that we've been enjoying right now, and we hope to enjoy in the future. So we may be sacrificing more of the future than we realize right now as we accept these higher deficits and spending over the long run. And I think that's unwise.
Right. Maybe AI will help us. It's a panacea, Thomas. I figured we agree on all this. So I don't know. I don't know when it. Well, I don't know when it comes home to roost, but you have to worry about that. It seems like, although we've been worried about it as long as we've been, I've been doing this. So, and it still hasn't. So.
Well, but I will tell you something though. We do see it. I mean, I've been saying it as long as too. But we had a major crisis in the 80s. We had a major crisis in 2000. We just dodged one here last year ago. So they're out there, and something could. I think as it builds, we'll break the dam, and then we'll have some real problems ahead. So I think it behooves the Fed to say enough. We're going to focus on stable prices, but also we're going to focus on maintaining a policy that retains that over a long period of time. We're not going to drop interest rates back to 2% anytime.
Okay, great. All right.